Let's talk about the financial metrics that every entrepreneur should know. I'm going to talk about the numbers in your business, but don't worry, I'm not here to overwhelm you with accounting jargon. Instead, I want to introduce you to a handful of financial metrics that can transform the way you run your business. Metrics are like the vital signs of your business. They tell you if you're healthy, where the business might be struggling, and what's working well. And knowing just a few key numbers can help you make smarter decisions, avoid surprises, and stay on track towards your goals. So here are some financial metrics that every entrepreneur should know. Let's start with gross profit margin. This metric shows how much money you're making after covering the direct costs, sometimes called your cost of goods sold, the direct cost of delivering your services. It's a simple formula. Your gross revenue minus your direct costs, or cost of goods sold, divided by revenue multiplied by 100. For example, if you earn $10,000 in gross revenue and your direct costs were $4,000, your gross profit would be $6,000 and your gross profit margin would be 60%. Next is net profit margin. This reveals how much profit you're actually taking home after all expenses. Next is net profit margin. This reveals how much profit you're actually taking home after all expenses. This formula is net profit divided by revenue multiplied by 100, and this metric is going to tell you how efficient your business is overall. Then there's cash flow, the lifeline of any business. Cash flow shows how much money is moving in and out of your business at any given time. Positive cash flow means you have the money to pay your bills, invest in growth, and sleep better at night. Another big one is customer acquisition cost. This shows how much it cost you to acquire a new client. Add up all your total marketing dollars and divide that by the number of customers you gained in that period. If you spent $1,000 and signed 5 new clients, your customer acquisition cost is $200 per client. Paired with your customer acquisition cost is your customer lifetime value. This number measures how much revenue you'll generate from a single customer over their lifetime. You'll multiply their average purchase by their purchase frequency and the lifespan. For example, if a client spends $500 a year and sticks around for 3 years, their customer lifetime value is $1,500. So how do you use these numbers to grow your business? Well, look at trends over time. Don't just focus on 1 month. Are the margins improving? Is your customer acquisition cost lower than your customer lifetime value? If so, you are on the right track. Metrics can also help you set specific, measurable goals. For instance, if your gross profit margin is 50%, you can aim to increase it to 55% by reducing your costs or raising your prices. Let's share a couple common pitfalls around metrics. First, don't track too many of them. Focus on the ones that matter most to your business. Second, don't ignore metrics just because they sound complicated. Start small, and you're going to build confidence as you go. Summing up, metrics aren't just numbers. They are the story of your business. And if you can learn to read that story, you'll always know where you stand and where you're headed. If you're not sure where to start, pick just 1 or 2 metrics today. Track them consistently, and I promise you'll start to see patterns that help you grow smarter and faster. If this sounds like a lot, don't worry. I'm here to help. Let's sit down together, figure out which metrics matter most to your business, and build a plan to track them easily. How does that sound?